For more on U.S. stocks, the economy, and everything else coming up this year, Anthony Chen, former chief economist, J.P. Morgan Chase. Good to see you again, Anthony. This has been a surprising last few months, if you will. The economy, there are still questions, but every data point that we see seems to point to it's not getting any weaker. There is no hard landing. There's no soft landing. It appears no landing. What are we worried about?
Well, I think we're worried about the fact that some consumers are still worried. If you look at some Gallup polls, given these fundamentals, they are, in fact, somewhat confusing to some people. I mean, if you brought in an economist from Mars and told them that we have unemployment rates close to 50-year lows, we tell them that in the fourth quarter, the economy grew by 3.3%, and the Atlanta Fed is telling you that we may do it again in the first quarter of this year, and the GDP could go up 3.4%. You would think that everybody would be happy, except that 63% of the people feel that inflation is a hardship. In reality, when you look at the numbers, Phil, it is not as much of a hardship, because one of the things I did was to look at how much consumer prices have risen from the prior to the pandemic. And what I found was since January of 2020, the CPI has gone up by 19.2%, but average hourly earnings have gone up by 21.5%. So consumers are a little bit better off, but it's not showing up in the polls.
Well, we don't need the polls to know that delinquencies, at least among the lower-end consumer, have ticked up, right? We've seen that in the data from credit cards. We've seen that in the car loan markets, both indicating a tick up in delinquencies. Is this, number one, normal? Two, is it something we need to worry about?
Well, anytime you see a small rise in delinquency rates, of course it's a concern. But it's normal in the sense that that's what happens towards the end or as the business cycle starts to mature. So that's not that unusual. What I focus more on is looking at how much wealth these households have created. 37.6 trillion from the fourth quarter of 2019 to the second quarter of 2023. These are Federal Reserve numbers, and they dwarf even all the credit card loans that are outstanding and the car loans that are outstanding. So what we have is a problem in the sense that the distribution of income has changed. And you are correct, Phil. It's that lower income that's struggling, but everybody else, or at least the middle to the upper income, are doing much better.
And then what used to be probably one of the mainstays or drivers of economic growth was workers, white-collar workers who go into an office building. And these days, we're really asking a lot of tough questions on the commercial real estate market. Now, these questions have been asked for well over a year, and with minimal consequences, right? The work from home trend, all this stuff. So that begs the question, are we first starting to see the shoe drop on the commercial real estate sector, or is it another cry wolf event?
Oh, no, I think the shoe is dropping. I mean, we've seen commercial real estate values going down almost 30%, and there is every indication to suggest that you're going to see more declines in 2024. Now, before you panic, Phil, we got to realize that when you look at banks, most of the exposure is in the smaller banks, the regional banks. The larger banks have a very small exposure to commercial real estate relative to their loan loss reserve ratios. You've heard, of course, the New York Community Bank situation today, because again, they have a huge exposure relative to their loan loss reserves. And so that's a problem. And in fact, some estimates out there on the street suggest that we may see as much as $1 trillion, maybe even a little bit more, in losses from the peak. Remember that the commercial real estate market was $3 trillion at one time, and now most people would tell you that it's valued at less than $2 trillion. So those losses have to go through the system, and that's terrible, and we'll have to work through that.
Anthony, who takes those losses? Is it investors? Is it 401k plans? Is it private equity funds? As you say, maybe the small banks, but the small banks can't take all the losses. I mean, we saw what happened even with a little loss.
Well, remember that some of these losses will go away as the Federal Reserve starts lowering interest rates. But to answer your question directly, it is permeated across the spectrum. I mean, you even have some international banks. You saw overnight, you saw some Japanese banks, some German banks, European banks already experiencing some of the spillover from these effects. So it's really spread out. And while $1 trillion or even 1.2 trillion seems like a lot, to the extent that it's spread out, it doesn't get much worse and interest rates come down, it may be contained. But again, when we say that, remember that that was exactly what was said when we had the global financial crisis about subprime loans. And of course, that decided to become a lot worse. So we will see some relief as interest rates come down, but those losses undoubtedly will be felt, especially, as you correctly pointed out, that the work from home trend has not been eliminated, despite the fact that many companies are fighting against it. It still hasn't been eliminated. Until that happens, the commercial real estate sector will be in trouble. And by the way, we're starting to see some cracks on the apartment buildings also.
Speaking from Anthony Chen, LLC, working from home, quick question. What grade would you give this economy, not today, but come this summer? What numbers are you watching to make sure this economy is going to earn the grade you're trying to give it?
Well, I think that right now I'm going to continue to look at employment. The good news is that there is a lot of pent-up demand. So I still give the economy a B+ by the summer, but at the same time, it is still far away from getting that perfect score because commercial real estate, the auto loans and the credit card delinquencies and the apartment buildings and interest rates are still too high. So we're still not at an A or an A+, but I think a B+ is certainly in the cards because remember, Phil, potential growth is about 1.8%, and both the fourth quarter of last year and the first quarter of this year are likely to be growing substantially above what we normally grow.